Mohamed El-Erian, When Markets Collide, Investment Strategies for the Age of Global Economic Change. Welcome to the world of When Markets Collide, where Mohamed El-Erian guides you through the rapidly changing landscape of global economic and financial systems. As you delve into this summary, you'll understand the major transformations that led to the collapse of the U.S. mortgage market in 2007 and how to navigate shifting demographics, novel financial instruments, and emerging economies. Furthermore, learn how to differentiate between the noise and fundamental change and the importance of adapting strategies to embrace these new realities. Recognize the first signals of impending change, unravel the intricate factors behind market fluctuations, and acquire valuable insights into successful investing in this new age of global economic change.
Navigating economic transformations. Understanding market noise and fundamental shifts in the economy is crucial for investors to safeguard against financial losses and identify potential profits in a constantly changing environment. This summary highlights the significant role of emerging markets, financial innovations such as derivatives, and the proliferation of structured investment vehicles. By comprehending these shifts, investors can perceive potential gains and dangers more accurately. The transformation of financial markets. The financial markets experienced a significant transformation over the past few decades, with events that were once considered rare becoming commonplace. This period saw developing nations shifting from being debtors to creditors, affecting foreign exchange rates, company valuations, and bond prices. Despite causing confusion among investors and policymakers, this change has resulted in a more stable global economy and new sources of capital. The rise of leveraged products and willing investors further accelerated these shifts. However, these changes also produced unusual behavior in the U.S. stock and bond markets, such as the inverted yield curve, which penalized bond investors with longer time horizons. Overall, the transformation of the global financial system has completely redefined the financial markets operations, making it an essential consideration for investors and policymakers alike. The 2007 credit crisis. Many experts look to the IMF to act as a main adjudicator during the 2007 credit crisis, but the organization lacked the expertise to foresee the impact of new products on banks and their balance sheets. The crisis began with the surprise meltdown of U.S. capital markets in July 2007, catching regulators and most large investors off guard. Developing markets fared better than America did, purchasing debt from developed nations at bargain prices. The crisis set the stage for global financial change. However, most people fail to recognize fundamental shifts, often making the same mistakes rooted in behavioral finance and neuroscience. The correct reading of history suggests that it is best to dismiss the notion that things will be different this time around. Investing in developing markets. Investing in developing markets is crucial for predicting future economic events. As emerging nations continue to experience surpluses in their internal reserves and current accounts, investors need to analyze if they can sustain their positive momentum, thereby affecting trade patterns. Moreover, managing larger capital inflows will be a big challenge for developing economies, although they can fashion appropriate policies to direct the situation effectively. In this context, investors must carefully analyze extreme events and be mindful of policymakers' mistakes while implementing market breaks. Global investment strategy. For investors to gain from investment fluctuations, proper asset allocation and financial vehicle selection is critical. They should determine asset allocation using a 3-year horizon, but review choices annually. Consider investing in a globally diverse equity portfolio, instead of just US-based equity. For a balanced growth, the equity allocation should be 30% to 54%, with a maximum of 1/3 to a half of US equities. Bonds allocation should be 10% to 18%. To protect against inflation, portfolios should contain real assets like real estate and commodities. Hedge funds and private equity investment options have a role to play but require careful management selection and often have long holding periods. Global economic transformations. As the global economy evolves, multilateral policy modifications will be required from all participants. Investors must understand these changes, which will affect investment information quality and economic indicator accuracy. To stay competitive, America must address its current account deficit and exchange rate differentials, cut household debt, and enact stricter loan requirements. The U.S. should also improve debt liability management by issuing debt along the entire yield curve, maintaining predictable issuance schedules, and promoting liquidity for individual issues. These changes will improve credit risk management and pricing while increasing market liquidity. Managing risk in the global economy. With the global economic variations, better risk management practices are essential. While individuals rely on professionals, money managers have several tools at their disposal, including hedges and tail insurance. Diversified portfolios including different geographic locations and asset classes also play a crucial role in managing risk. Additionally, redirecting global capital to emerging market nations will increase volatility and result in global disinflation. This transformation can help rectify income inequality and poverty, but public and private cooperation is necessary to implement relevant policies and regulations for a more stable investment environment and improved performance.
In conclusion, When Markets Collide emphasizes the importance of recognizing and adapting to the ongoing transformations in global economies and financial systems. The summary underlines the need to acknowledge and respond to groundbreaking financial instruments, emerging markets, and the growing interdependence among global economies. Investors must comprehend these new realities to spot potential gains and pitfalls, while also adapting to changes in asset allocation, diversification, and risk management. Furthermore, governments, policymakers, and investors must collaborate to foster improved economic and financial environments, paving the way for sustainable growth and stability in our global economic system.